Hey everyone, this is Ben with OTCAlpha.com, and today's lesson is all about investing versus trading and why it's crucial to know the differences as a penny stock trader. This lesson is part of a course entitled Penny Stock Basics we offer for free at OTCAlpha.com. Just sign up for our basic membership plan and you get this course and others absolutely free. Let's get to today's lesson, which is investing versus trading. And let's start out with investing. Now, investing is taking a long-term position on a security or stock and ignoring the short-term fluctuations. So it might go up 1%, down 1%, whatever. You don't care. You're in it for the long haul. You're not trying to capitalize on the short-term gains, but you're looking at it as a long-term perspective play for your portfolio. Now, TA, which is technical analysis, we won't get into that further, but that may only be used for deciding when you should get in and when you should get out of the stock. Now, position traders place their positions based on actually believing in the company. So an example of this might be, hey, I'm really wanting a cup of coffee right now. So I walk into Starbucks, I get a cup of coffee, it's delicious. Not only that, the employees are smiling, the culture of the company is looking great to me. And I go home and do some research and I'm like, oh man, Starbucks, they're a profitable company, they're growing, and I think there's potential. So I believe in this company, I like the product, I like what I see, so you take a position in that. Now, a lot of position traders, that's a typical case because when you're passionate about something, when you really like something, you want to invest in it or own a piece of it, which, when you buy shares of a company, you're owning a part of that company. So, a lot of position traders base it on passion and belief, but that's not all you should look at. They also, look at the financials and the earnings. Any forward-looking events or possibilities, such as buyout targets, acquisitions. Are they a small company that has the potential of being bought out by a bigger company? And other, growth factors and forward-looking possibilities for that company. Now, other perks could be dividends, cash payouts, stock payouts. That's a good reason for a position trader to get in. You can consistently get that little dividend. That's kind of nice. Now, in the stock market world, another name for this is a position trader. A little more about position traders. They build wealth slowly over a period of time. Like I said before, they're in it for the long haul. A good position trader can expect about 10% portfolio growth annually. So, obviously with that amount of growth, it's nothing huge, but it's nice and consistent. Maybe it's, for a retirement plan or just some extra cash. Just another egg in another basket to have, another income stream. And, obviously they have other jobs. They're investing in stocks. That's a diversification strategy. It's not a full-time job. They're not taking home a paycheck. They're keeping their money into these positions. They're not, withdrawing money every day. So yeah, that's position traders. And, for position trading, it's a very bad strategy for penny stock traders. I highly, warn you against taking a position that's a long-term strategy as a penny stock trader. Why? Because they're highly risky, as most penny stock companies are just starting out. These are startup companies. A high percentage of these companies will go bankrupt. Some of these companies, just to be flat out honest, are scam companies. Some of them are legit, but that doesn't mean or guarantee they're going to make money or grow up out of the OTC markets and the small cap tier and become a huge corporation. Now, not watching a position on a daily basis, it could result in losses of great magnitude. Now, I'm going to give you a little example. A couple years ago, I was in a stock. I went to take a pee, to relieve myself. And when I got back, 2 minutes later, I lost $500. And, the thing about it was I knew that stock was not going to go back up. It was a momentum trade. And so I just lost $500. It was a $500 pee. So you can't even leave your computer sometimes for, 20 minutes, let alone 2 years or a year or 6 months. You have to be watching your trades. You cannot take a long-term approach. Your shares could disappear, lose value, or fall victim to a reverse split, etc. Long story short, just don't do it. It's a bad idea. Now let's talk about trading or day trading. That's what we do. We take a very short-term position. Many times we're in and out of a stock within days, hours, minutes, seconds, etc. Now, how long you're in a stock really depends on what style of trader you are or what strategies you deploy as a day trader. And we do cover that in the next lesson of this course. Or if you found this on YouTube randomly, just go to the playlist and click the video after investing versus trading. Now, we make trades based on charting or technical analysis. News or forward-looking events. So we look for something positive coming out from the company, like an LOI, a new contract, a merger perhaps, some kind of catalyst that we can profit off of in the short term. Another thing to look for is share or dollar volume spikes. We have a saying in the market, volume precedes price, or volume precedes price. So if you see volume, that's a good indicator, not a guarantee, but a good indicator that the price could go up of a stock. So especially if it's unusual activity, much more volume, whether it be the shares or the dollar amount for the daily, the moving daily averages. I have an alert set up. If a stock starts seeing a big influx of volume, I get an alert just so I can take a look and see what's going on. This is a big one. We make trades based on hot sectors or market trends. Now, at the time of this recording, Bitcoin, anything cryptocurrency, blockchain, that is the fad right now. That is the new wave in the public and private markets. A lot of money coming into those. So any, OTC companies, any small cap companies that are, putting out press releases or merging or anything with the words Bitcoin or cryptocurrency or blockchain, those are going up. And you'll notice waves going through the penny stock market based on these sectors that all of a sudden, all these companies are now Bitcoin companies. And if Bitcoin fades out and it's cannabis again, then, we're also going to be cannabis companies now. So just like the companies kind of play this game, we do as well as traders. And we capitalize off of these hot sectors and market trends where the money is coming into. Give you a little anecdote. I traded a company the other day that was a medical transport company, and they just put a press release out, a PR, saying they're investing in Bitcoin, not that they were making a deal with some kind of cryptocurrency company or using blockchain technology. They just put Bitcoin in their PR, and that caused the stock to go up. So that's just a little insight into the weird organism that the penny stock market is. A little more about day traders. We buy and sell stocks at high frequency. We don't believe in or care about the company, only if they have a good story to profit from in the short term. So we're not the Starbucks, long-term believer, investor, position holder. We don't drink the Kool-Aid. We only care about if the company put out a nice catalyst for us to make money off of. We also expect big returns and take bigger risks, looking for triple-digit gains. That is us. All right, so let's recap today's lesson. Investing is long-term positions based on the belief in the fundamentals of a company, and trading are short-term trades based on short-term catalysts. Examples are news, filings, financials, trends, etc. I hope you enjoyed this lesson, found it informational. If you did, please subscribe to the YouTube channel. And if you want to take this course for free, as well as others, sign up for the basic membership program at otcalpha.com. Thanks a lot, everyone, and happy trading.